Okay, everyone, I think we're going to get started back up again. Welcome back. So my buddy left me, I think. I don't know if he's still here, but I have a couple of comments for him. First of all, he implies that we've been doing this for years and years, so he's making me feel very old. So I don't know if I like that or not. Secondly, I do have reading glasses, and I'm in denial, so I'm not going to wear them. So how's that? It's perfect. You know how women don't want to get old. Anyway, welcome back. Hope you've enjoyed the first half of the morning. I'll be taking you through to lunch, so you're kind of stuck with me for the next hour, hour and a half. We do have a number of important topics that we want to get to, not the least of which is IFRS 16 on lease accounting, so we'll go through and do a lot of a deep dive on some of the details around that standard. We also have a good section on regulatory and hot topics that you won't want to miss. Some interesting developments in that area, particularly around the area of non-GAAP measures. So if you've received, let's say, a comment letter over the last couple of months, or maybe you're in the middle of responding to one, you'll want to stick around for that. Okay. So, lease accounting. Let's get into the details. So most of you are aware or have been through and read the entire standard, right? Everyone can nod. Yes, we've read the whole standard. It was issued back in January, so the ISB issued IFRS 16. The FASB issued their respective standard in February of 16, albeit it's a slightly different model. If you've read that one as well, you'll see there's some very obvious differences between the two models. And it's hard to imagine that there aren't any companies represented in the room today that aren't going to be impacted in some degree by the leasing model or the change in the leasing model. So it really will depend, how much you're going to have an impact will really depend on what industry you're in. Let's say, for example, if you're in the retail and consumer space, you probably feel more of a pinch because of the blow up on your balance sheet of all of the assets and the respective liabilities. A lot of industrial manufacturing and commercial type companies that have a lot of leases off balance sheet for facilities and equipment, they'll also see quite a significant impact. Business services type companies, a lot of people with high levels of real estate leases also will be significantly impacted. But like I said, we're going to look at a lot of the details, but if I had to really step back from the standard and say, well, what are the really big things I need to know right away? First of all is everything's going to go on your balance sheet, so there will be a significant gross up to your assets and your lease liabilities. We've all seen the statistics. There's one on the slide right now that companies' balance sheets are going to swell by $2.8 trillion. That's quite a significant number. If you look at the leases alone that were written in the U.S. on equipment in the last year, I think it's to the tune of about $900 million of leases just in equipment alone. So those are some pretty significant numbers, and there's a whole bunch of other statistics in terms of who's going to be impacted the most. But that's the number one thing you're going to have to keep in mind with respect to lease accounting. The second thing, with all of these leases now going on your balance sheet and all of the various contracts that companies have entered into, it's going to be scoping through all of this data and having the processes in place to do it in a systematic way with controls around that. Sean mentioned controls earlier on this morning. So I think it's this issue around, have I identified all of my leases that's going to be critically important. It's easy to say, well, I have, here are all the papered leases, and they're all listed, and I've been accounting for them as operating leases all this time, and they're labeled as leases, and you know what they are. But what about all the things that are embedded in your contract that constitute and meet the definition of a lease that you hadn't previously identified before? I know you're probably thinking, well, didn't I have to do that already under IFRIC 4? And you're absolutely right, but the consequence of not quite getting that right is not that significant. Because remember, if you had an operating lease and you had an arrangement that was a non-lease component, but you hadn't quite properly separated that out, it didn't have an impact on your balance sheet because everything's off balance sheet, and everything went through operating income somewhere in your P&L on a straight line basis. So the consequence of getting it wrong, and I'm not suggesting that anyone got it wrong, but the consequence is not that big. The final point that I think you need to take away is if there's anyone in the room that works with a multinational company or has to worry about US GAAP, the two standards are not the same, okay? So there are some differences, particularly around income statement recognition, obviously. The balance sheet, they've all agreed, everything goes onto the balance sheet, but the income statement stream is quite different. So you'll want to pay attention to the differences between US GAAP and IFRS if you do have to report or dual report. Not only will you have to get the accounting right, but you're going to have the systems to maintain it separately. Okay, so let's start with a bit of a timeline to give you some sense of how much time you have and how you're going to plan for your transition, okay? So you're probably saying now, Carolyn, why do I have to worry about IFRS 16 if I don't have to adopt it till January 1, 2019? That gives us quite a bit of time, it seems, to adopt and plan for transition. Well, you know, I don't like to procrastinate. Well, actually, I do like to procrastinate, but in this particular case, you're not going to want to, because you're going to want to get into the details to figure out what the best way you'll transition into the new standard. And you'll also want to keep in mind there's some very significant standards that Sean talked about earlier that you're going to want to think about and have to get through before you can get to IFRS 16. The other thing you want to consider is maybe I want to adopt 16 at the same time I adopt 15. And that seems like a very overwhelming task, both from an operations perspective and a controls and a process perspective. But if you're out there and you're, let's say, a company that's significantly impacted by IFRS 15, and you have to adopt that on January 1, 2018, and think about it, you're shopping for new systems, you're evaluating, scoping all of the detail in your contracts. A lot of there's a lot of commonality between those two standards in some regards, particularly on the lessor side, where if you're outside of lease accounting and you're looking at a contract, you could be outside of it and then you have to apply the revenue standard, or you're looking at that same set of data to figure out whether or not you meet the definition of a lease, right? So there's a lot of commonality and overlap between the two standards, and there's also a lot of efficiencies that could be gained by implementing one set of systems and controls and processes to deal with both standards at the same time. So that's why you might not want to delay looking at some of the details of 16, because you may want to adopt it early. And the transitional provisions will allow you to do that. You can adopt it early, but only if you adopt it concurrently with IFRS 15. Okay? Now, there are some practical expedients that are available to companies transitioning to IFRS 16. The most important one you'll want to think about, and we'll talk about this a little later when we talk about the lease, the definition of a lease, but it's whether or not you have to evaluate all of your previous lease determinations on transition. So you can elect to say, you know what? The decisions I made about whether something was a lease or a non-lease, I'm going to leave that alone, and I'm going to assume that those determinations will remain unchanged, and I will only apply the new lease determination as of the date of adoption. So there's an element of grandfathering with respect to your old lease classifications, determinations, but there is no grandfathering for lease accounting. So not to be mistaken with, oh, I don't have to worry about putting those on my balance sheet, because that's not the case, okay? All right. Just before we move on, in terms of the transitional provisions, I do want to mention the standard will allow you to do a full retrospective adoption or a modified retrospective adoption, or what they call the simplified model. Full retrospective is the full deal, right? You recast all your comparative periods and you have an adjustment to your opening retained earnings, no practical expedients available, and you apply it on a full retrospective basis. If you elect to do a modified retrospective adoption or transition, companies would not restate their comparative periods, but rather if you assume, let's say I adopt in 2019, I will have an opening adjustment to retained earnings as of Jan 1, 2019, with no restatement of comparatives. Depending on which way you go on IFRS 15, that might drive how you determine 16 to some degree. Some people like the comparability that you'll get if you do full retrospective. So I think it really will depend on a company-by-company basis. I think it also might depend on maybe what some of your competitors in your industry are doing. Welcome back. You missed my opening joke. I don't know. What? Are you curious? Okay. So let's start by talking about the lease definition, okay? Because this is, as I mentioned, is going to be fairly critical to the analysis, and it's going to be a very sensitive judgment that you make to the extent you have significant lease and non-lease type elements in a particular contract. And the reason it's such a big deal is, again, we're talking about taking assets for the lease component and putting those on your balance sheet and the respective liabilities, whereas the non-lease component stays off your balance sheet. So as you can imagine, this will become a new gating issue. It's almost like the scoping issue of getting into the standard or not. So it's going to be quite important. Let's just keep going here. Okay, so what is the lease? What is a lease? How is it defined? Well, a bit of good news. The good news being that it doesn't really change that much from the definition that you're used to seeing in IAS 17, okay? So it's still the same standard definition where you have a contract or a component of a contract that will basically convey a right to use a particular asset over an identified term, and it has to be a specified asset in exchange for consideration. So that definition in and of itself is relatively the same as under IAS 17. Now, what the standard did do, however, is it said, well, we're going to need some addition, because this is such an important definition, we're going to put a lot of application guidance and examples around it and on how it should be applied. Okay? So as you go through, you'll see, well, you'll recognize parts that have been imported from other standards, such as IFRIC 4, in determining whether an arrangement contains a lease. So they have brought all that into IFRS 16 and made it part of the application guidance. And it's relatively the same as what was in IFRIC 4, but it's not identical. And the fact that it's not identical, that's where you're going to see some differences in your conclusions as to whether or not you have a lease or not, okay? So the key takeaway for you is there could be some surprises. You might have something previously determined as a lease that all of a sudden falls outside, and vice versa. Now, the definition itself really has kind of two key attributes, and we'll break them apart a little bit because I think that'll help in understanding it. The number one, though, is that you've obviously got to have an identified asset in the contract. And the second part is the contract itself must convey the right to control that asset throughout the duration of the lease term. So those are the two very essential elements that you need to have. So if I could just put it in really simple terms, if I enter into a contract and I have control, I'm the customer and I have control over how that asset is being used, then it's probably a lease. If I enter into a contract and there's an asset that's being used to provide services to me that I cannot control, then it's probably a service arrangement. Okay? Now, as I mentioned earlier, there is a practical expedient for all of this if you don't want to start fussing with your previous determinations. It's an all or nothing election. So if you decide you want to leave alone all your prior lease determinations, there's no cherry picking on a contract by contract basis. You have to pretty much apply it to all contracts and all arrangements previously, and then you only start applying this new definition to any new lease contracts as of Jan 1, 2019, if that's your date of adoption. Okay? So what's an identified asset? Well, the good news again, if you look in the words in IFRIC 4, they use the concept around a specified asset, but conceptually it's just a different term, but it is basically meant to mean the same thing. So this would be something that it's explicitly identified in the lease contract or the contract that you're looking at. It could also be implicitly identified. So for example, if the supplier of that asset really only has one that they can lease to you, then it's implicit that that's the single asset that will be under the subject of an identified asset in the contract. This asset can be a physically distinct portion of a much larger asset. Best example I know of this was, I'm leasing 5 floors of a 20-floor building. So it's physically distinct. but not to be confused with capacity. So another good example of capacity is I'm going to lease 50% of a pipeline. That would fall outside of an identified asset because there's other big significant components to that asset that are being leased to other third parties. So that would not qualify as an identified asset under the definition, okay? Now, the one area that companies are going to want to spend a little time on and will require judgment is around substitution rights. And those substitution rights reside with the supplier, remember. So as a lessee, you're sitting there going, well, I need to figure out whether the substitution right is substantive or not, and that's more of a judgment call, because how do you really know whether or not that the supplier has what they would consider to be a substantive substitution right? Now, the standard helps you out a little bit, and they say, well, we'll give you a couple of criteria that you need to meet in order to have a substantive substitution right. And it basically means if the supplier can go in and swap out that asset, and it's practical for them to do that, and it's also economically beneficial for the supplier to do that, then that substitution right would be substantive, and so therefore you no longer have an identified asset, right? Does that make sense to everybody? So if you look at a company, let's say I'm leasing a fleet of vehicles, and they're all been placed out into the field in the customer's relative locations, let's say. Is it really practical for the lessor to say, well, I'm going to swap out and give you alternative vehicles at any point in time? It also may not be economically beneficial for the lessor to do that. So you have to make that judgment call. The same with real estate. Is the lessor going to be able to practically relocate you between different floors within a particular building? Is it economical? I think all those types of judgments are ones that you'll have to make to determine whether or not something is a lease or really just a supply contract. A good example of where you might think you have a lease, but it's actually a supply contract, often happens when you enter into a data outsourcing arrangement, let's say, for servers on a computer hardware system. And that the servers are serving, you're leasing the capacity or space within that server, but the supplier has the ability to swap out that server and move capacity from one to the other. That was likely going to be kind of like a supply arrangement or a service arrangement. Okay, because you don't have a specified asset. Okay, so that's the identified asset. The other element that you need to focus on is whether or not I have the right to control that identified asset. Okay, now there are really two elements that are essential to evaluating whether you control an asset. And they're going to look a little familiar to you. And the reason they look familiar to you is it kind of lends some of the concepts from IFRS 10. So for those of you that think they have a really good grasp on IFRS 10, this will be a walk in the park in terms of determining whether or not you have control. There are two elements that you need to have, which is one, the benefits element, and number two being the power element. And you all remember those concepts when we looked at IFRS 10 around whether you controlled another entity. So what is the benefits element really talking about? Well, do you have substantially, under the lease contract, are you getting all of the substantial benefits from that asset? Okay? So conceptually, that'll be very similar to what you're used to seeing in IFRIC 4. Okay? That means you're getting all of the primary output from the asset, or if I've subleased it to someone else, I'm still getting all the primary benefit through that sublease arrangement. The important thing to keep in mind is the scoping on that substantive economic benefits. And the scoping is confined to the term of the right of use asset. It's not the life of the underlying asset, but it's going to be, if I've only got a 5-year term, then I look at the scope and the economic benefits I'm getting from that 5-year term. Now, the one area that the standard is going to be slightly different to you, and this is where the definition is different, is under IFRIC 4, you only had to have one or the other. You could either have benefits but not power, or you had power over that asset but not the benefits. What the standard does under IFRS 16 is it requires you to have both of these elements. Okay? So that could change your determination under the definition. I want to touch briefly on variable lease payments when it comes to economic benefits and having those benefits. There's this concept that, if I have variable lease payments that are based on usage or percentage of sales, so I'm going to write a check to the lessor for a percentage of my sales from my store based on, and so it has that variability over time, that I'm sharing the economic benefits, and so therefore they're not all substantively flowing through to the lessee. The standard was very explicit in IFRS 16 to say that will not, in fact, taint your benefits conclusion. So, and they did this very specifically because, as you can imagine, companies could really, use contingent payments to really game the system to try and get outside of the lease definition, to say, well, I've got significant contingent payments I'm paying to my lessor, so therefore, obviously, I don't have substantively all of the economic benefits, so you're not meeting that element. So that's a significant item that we get a lot of questions about. Let's go to the power element, because that's the other piece that you need to have. So it's not just I'm getting all the economic benefits, but I also need to have power over the asset. And this is what I like to describe as how is the asset being used and for what purpose. That needs to reside with the customer or the lessee in this particular instance, right? How is it being used and for what purpose? So you're determining, what type of output is being used, it's being used for. If you're leasing shipping containers, you should be the one to decide whether I'm going to use them for storage or whether I'm going to use them for actual transport. The customer has to be able to be in control of that decision. What about output, or how much time the actual asset is being used, or capacity of the asset? All of those decision-making, the relevant decision-making elements need to reside with the lessee or the customer. Now, this all sounds fairly straightforward, but sometimes when you get into these contracts, everything is predetermined under the contract, okay? And so it becomes much more difficult to determine who actually has the power over a particular asset, because it's all preordained within the terms of the contract, and there's contractual restrictions and things of that nature. So the way the standard setters got around that is to say, well, the customer can still have power over that particular asset, provided the asset has been customized or designed specifically by the customer, so it's fairly unique, and therefore they have power over all of how that asset will operate. Or alternatively, it's preordained in terms of how that asset will actually be used. Okay, so just because something has been predetermined under the contract in terms of how it's going to operate, it might seem like it's on autopilot, but all of those terms and conditions have been laid out by the customer. All the operating instructions are laid out by the customer, and the supplier of that asset can't go in and change those operating instructions, so to speak. Okay? Things like protective rights, those won't kill power. It's just like under IFRS 10, you could have protective rights. Doesn't necessarily mean you don't have control. Okay? So what are the consequences of all this? You've gone through all your analysis, you've figured out what your exemptions are, and you've decided whether or not you have a lease or not, and now you're ready to do your accounting for your leases. And you're on the lessee side of things. So what's the major impact? Well, as I said at the beginning, everything is going to go on your balance sheet. You're going to have an asset, and you're going to have a lease liability. So what's it going to look like? Well, first of all, you're going to have a right-of-use asset, you're going to have a lease liability, and then you're going to have an income statement effect that will comprise of depreciation, you're going to have interest expense, and you're going to have potential impairment on your asset. Okay, so you're going to have three streams through your P&L. Now, I do want to mention a couple of practical expedients, or I call exemptions, from having to put things on your balance sheet, and those relate to two items. One being your short-term leases that are anything less than 12 months. Those you could potentially be exempt from having to put those on your balance sheet. And the second one are small ticket items. They don't actually define what a small ticket item is, but it would be implied to be anything. I think the basis for conclusions, they hang their hat on the fact that it talked about it being around the $5,000 mark. But it's on a contract-by-contract basis. So if you have 1,000 individual leases for a $5,000 photocopier, then technically that would qualify as a small ticket item because it's not done in the aggregate, it's actually done by individual contract by contract basis. So those potentially could be exempt from the application of this guidance, okay? So those are the only two exceptions though. Everything else, every other lease of equipment or any other large particular items will end up having to go on your balance sheet as a finance lease. Okay, so I want to talk a little bit about components or multiple elements within a contract, because this will be important for you to really focus on whether or not you have embedded leases within one single contract. I've mentioned this already. Up until now, it wasn't so critical that you got the split appropriately taken care of, because basically the P&L or the straight line expense would have gone through the P&L. The impact would have been the same. Now, with everything going on your balance sheet, it's going to be important that you split out your lease and your non-lease component within the contract. And the way the standard setters decided to deal with this is they said, well, how are we going to figure out whether something is a lease or not? Yes, you can look at the definition, but there also has to be other gating criteria to determine whether or not I have a distinct lease element. And the way they've done that is they've borrowed some concepts from IFRS 15. So basically, you would be able to identify a lease component within a contract, provided that you are identifying whether that performance obligation under IFRS 15 is distinct. Okay, so you use similar criteria. So what are the questions that a lessee would have to ask themselves? Well, first of all, can they benefit from the use of that asset on its own or together with other resources that are readily available to it? And secondly, is the underlying asset not highly dependent on the other services that are being provided within the contract? So those are going to be the two criteria that you need to evaluate to determine whether I have a lease or a non-lease component within a single contract. Okay? Now, there is a practical expedient for companies that have looked at their non-lease components and determined that they're not significant. You can elect to say, you know what, I'm going to forgo breaking my components out into two separate elements, and I'm going to account for everything as a lease. But remember, when you do that, that means everything goes on your balance sheet, and it has to be done by class of underlying asset. So if I have significant leases of equipment in the same class, you have to make sure that your non-lease component is not going to be overly material, because you're going to end up with an asset and a liability related to that non-lease component on your balance sheet if you choose this election. Okay? Let's just briefly look at the lease term. And the lease term is really going to be important because it's really going to determine how you record the lease liabilities and the lease payments, and how you then also ultimately record the right of use asset. So the starting point you need to think about in terms of the lease term is, you know, is it similar to, I always say, is it similar to where you're coming from? So if you look at the lease term under IAS 17, chances are you're going to end up in the same spot as you did under that existing standard. So you're going to be looking at any non-cancelable periods that you have, any option renewal periods that are reasonably certain of being elected, and you're also going to look at any options or penalties that you may have to pay to terminate if you think it's reasonably certain that you're going to incur those costs. So that's relatively the term that you would establish in order to capture all your lease payments. You're going to want to focus more on the reasonably certain guidance and how you evaluate that, and the standard provides a lot of application guidance and a lot of examples on how you can evaluate what constitutes reasonably certain. It puts things into groups or categories. So for example, it takes you to look at the asset itself. So let's say I've invested significantly in leasehold improvements. I've got a significant investment in that particular property, so there's a good chance that it's reasonably certain that you're going to extend the renewal period. So that gets embedded into your lease term. Okay? You also want to look at the contractual terms and how they compare against the marketplace. So let's say I have an option renewal period, but the renewal term is off market. It might be favorable or unfavorable. That will largely determine whether something's reasonably certain of being exercised or not. Again, we're not expecting to see wholesale changes on this particular area, but there could be a few surprises, so you want to pay attention to some of the examples that are in the guidance. So once you've established what your lease term is, the next step is you're going to want to look at your lease payments. Okay? Again, good news. It's very similar to IAS 17. So IFRS 16 will have you include all the fixed lease payments that you have, and these are really the unavoidables, the unavoidable costs. It'll also include any in-substance fixed payments, and we'll talk a little bit about what that means in a moment. And you'll also back out any lease incentives that you would have received or are receivable. It also includes lease payments that are dependent on, that are variable, but only variable because of some index, like a CPI index or some interest rate index. You're also going to include any amounts you expect to pay under a residual value guarantee. These aren't really variable. They're only variable because you're making your best estimate of the amount. So the variability is only as a result of what's the expected amount that's going to be the residual value guarantee versus what I ultimately pay. I think under IAS 17, when you had a residual value guarantee, you would have booked the maximum exposure that you had. The way the standard works under 16 is it actually requires that you use the expected amount you expect to pay. So it's not the maximum exposure. You're also going to include any exercise prices that you have under purchase options that are reasonably certain to be exercised, and if you had any penalties. So you have to factor all those into your lease payments. I want to talk a little bit about contingent payments, because that'll be the important piece you'll note when you go through IFRS 16. They really put them into kind of three categories of contingent payments. The first one being in-substance fixed payments. And what I mean by in-substance fixed payments is these have no genuine variability. In other words, they're in all likelihood fixed, but it's not fixed until a certain point in time, but you know you're going to have to pay a certain amount, so you make your best estimate at the inception of the lease, and you adjust as you go throughout the term of the lease until you actually make that final payment. Okay, but it is in substance. You know you're going to have to pay something, so the variability is it's not genuine and it's unavoidable. The other one is variable payments that are based on an index or a rate. As I said before, these are unavoidable payments. What IFRS 16 says is you have to make your best estimate of what that amount is going to be at the inception of the lease. And you use that as part of your calculation of your lease payment, and then you adjust as you go. Okay? And that will be a trigger-based assessment of changes to that variability. The third category of contingent payments, and the ones that I spoke about earlier, are the ones that are based on usage, or like a royalty or a percentage of your sales. These amounts will be excluded from your lease payments, okay? And they'll be just bucketed within your other operating costs, okay? So they're outside of lease accounting, so they are not going to be baked into your lease payments. Okay, so now that you've determined what your lease term is, you know what lease payments to scope in throughout that lease term, you're now ready to book your lease liability, or certainly your asset and your liability. So the lease liability is going to be based on the present value of your lease payments during the lease term. Okay, pretty simple. IAS 16 actually uses a single model, so you'll only be doing it on a present value basis. If you look in the words of IAS 17, it would say you would use the lower of the fair value of the asset or the present value of the lease payments. That option is not available under IFRS 16. You would discount it using an incremental, or actually you would start with your implicit rate in the lease, if it's known, and if not, you would use some form of incremental borrowing rate based on an equivalent rate over a similar lease term. Once you've recorded your lease payments, you're then ready to record your lease asset, your right-of-use asset. And then the starting block for that is always your liability. So you transfer over your lease liability onto the asset side of the balance sheet. You're going to add to that any payments that you might have made before the commencement of the lease term associated with that asset. You're going to back out any lease incentives that you might have received prior to the commencement of the lease. You're also going to add in any kind of restoration type costs, or I call ARO type costs. Because remember, on the lease liability side of things, you have your lease payments recorded as your lease liability. But in addition to that, you're also going to potentially record an IAS 37 provision. So you'll need to apply the same guidance that you would under IAS 16 and book the corresponding asset as you would under IAS 16 guidance, okay? So that's also going to be an additional building block to your asset. Sounds simple, right? So what do you do subsequently? And this is where things get a little interesting, because up until now, companies have been saying, well, lease accounting, I pretty much, it's an operating lease, everything goes on autopilot, I present value and discount, figure out what my lease payments are, and away I go, and I don't really have to worry about a reassessment. But all of a sudden now I have assets and liabilities on my balance sheet. So there will be some degree of reassessing as you go in terms of revisiting what that lease liability is, because chances are in the subsequent periods, the actual lease payments that you make and the estimated lease payments that you included in your lease liability could differ. Because remember, we just talked about all that variability that you have as part of your in-substance fixed payments and all those things. Those will change. So as your actual payments change based on what your initial estimate is, you're going to have to make adjustments to your lease liability. And once you adjust the liability, you're going to have a corresponding adjustment to your right-of-use asset. Okay? Now, the biggest challenge you're going to have is figuring out what discount rate to use. Do I use the original rate that I used at the inception of the contract, or am I going to have a revised discount rate? And I think it really is going to depend on what the nature of the change is. So if the change is largely based on some change in estimate that I made at the inception, let's say, for example, my residual value guarantee payment, if I've changed that estimate on what that payment is going to be, then I'm going to change it and discount that amount using my original discount rate. So I'm not going to use a revised, updated discount rate. Now, you would use a revised or updated rate for things that are changes. So, for example, changes to the lease term, for example. That would cause you to change your lease payment amount, and you're going to want to use a revised or updated discount rate because the economics of the lease have changed. So you really need to put it into two categories on whether or not it's a revision to an estimate that I've made at inception based on the original terms, or the economics of the lease entirely have changed, therefore I need to have a new discount rate, right? So those are the two categories, and there's lots of examples in the standard on how this should be applied. So that's the lease liability side of things. Remember, you also have reassessments on the right-of-use asset, okay? You're going to put the asset on your books. You're accounting for it under IAS 16, so you're either going to use a cost model or a revaluation model. If you have an investment property, you may be accounting for it under IAS 40. But either way, you're going to have adjustments and changes to that asset. So you're going to have depreciation on the asset, or you could have impairment, okay? There could be other things that would cause you to have to reassess or adjust the amount of that asset. And I've just spoken about, the lease liability could change, and as that liability change, I have to make a corresponding adjustment to my right-of-use asset. The one thing you need to keep in mind, though, and this is really the concept around, we spoke about, I think in prior years, around the whole notion of front-loading of your expense. Think about your asset and your liability. The asset's going to be depreciated, let's say, on a straight line basis. So that asset and the carrying value of that asset is going to fall probably at an accelerated pace as opposed to the effective interest rate model that you apply to your lease liability. So you will not have an equivalent asset and liability. So I don't want you to leave the room here today and think, okay, both carrying value of my asset and my liability are going to be the same at all times, because that's not the case because of this front-loading effect. So you're going to want to watch for that when you go through your reassessment phase. Okay, what about presentation? So on your balance sheet for a lessee, you're going to have an asset and a liability. You can kind of group them within other assets and liabilities on your balance sheet, with the exception, of course, of investment property, and those have to be separately presented. If you decide you're going to combine them with other assets or liabilities, there's a lot more disclosure you need to make about those specific leased assets and the right of use asset and the lease liability. So you'll end up with more disclosure in the note, but you do have a choice. So in other words, you don't have to have a separate line item for the asset and the liability. In terms of the P&L presentation, you'll have a depreciation expense. That'll be grouped with other depreciation of other assets. You'll have interest as part of your finance costs. And you'll also want to think about where you're going to put any operating costs associated with your short-term leases, let's say, or your small ticket items that you decided that you're going to apply the exemption. There's nothing specific under IFRS that says where those must be disclosed other than existing IFRS guidance, let's say under IAS 1, for example. Cash flow statement will be a little different. Obviously, the principal portion on the lease payments amount, that cash flow will be presented as a financing activity. You're going to have the interest portion on the lease liability also going through as either a financing or an operating, depending on what your election is, your accounting policy choice. And payments on your short-term items or your small ticket leases, those are all going to remain as an operating cash flow. Okay? So let's take a look at some of the disclosure. There will be a lot of disclosure. I don't want to go through all the different detailed elements of the disclosure. I'm sure you don't want to listen to me do that. I do want you to remember two things about disclosure. Number one is there's a core principle that if you've got a lot of leases and you have significant assets and liabilities that are leases on your balance sheet and obligations associated with that, it's going to be important that there's a lot of transparency around that. So if it's very material to you, I think it's important that you have really good disclosure. The other thing is the standard setters saying, let's try and put all the disclosure in one place, so you're probably going to have one note. And a lot of the quantitative information that you're required to disclose, they're encouraging, not requiring, but they're encouraging to have kind of it in a table format. And so I think a lot of the examples you'll pick up and see are going to be presented on that basis. But I think the two things you need to take away is, don't get lost in the fact that maybe you only have a handful of leases and they're not significant. It's just like the old, I have a tiny little defined benefit plan, and you get to IAS 19 and there's, 20 pages on disclosures you need to make. Well, you need to gauge and use your own judgment around materiality. Do I need to have all of these disclosures? So I really think it's going to be dependent on how significant leases are to a company. Okay, so you can use materiality as your guide. Okay, let's talk a little bit about lessor accounting, because I think these guys got the better end of the stick. So if you're sitting there and you're a lessor, this is going to be a cakewalk, right? And the reason it is because IAS 17 was cut and pasted into IFRS 16. Okay, and so there are very few changes. There are a couple of items we'll touch on, but for the most part, no significant changes, which is interesting because if you're a lessor and you're adopting IFRS 16, companies are not supposed to have adjustments on adoption. But it kind of reminds me a little bit of when we transitioned to IFRS and we had two standards all of a sudden that were the same, but everyone's looking at all the details and they're like, oh, I think we've been doing that wrong all along. And so you might think you have little adjustments here and there. And that could happen, but They might be errors, but I don't want to say that too loudly. But the concept is that on transition, you probably won't have any significant adjustments, okay, if you're on the lessor side of things. You're still going to get to classify things as operating or a financing if you're a lessor, so that's the good news. A lot of the terminology is the same. A lot of the paragraphs are identical. There are two things I want to talk about, and those are going to relate to subleases, and we'll talk just slightly about modifications. I don't want to get into too much of the detail because modification accounting under leases can be a little tricky. So what's the deal with subleases? Well, a standard sublease is structured as, I'm a lessee, I'm leasing an asset, so I've just gone through all of the guidance around lessee accounting. I've now put the asset on my books. I have a right of use asset and I have a lease payment. Now I decide I'm going to go out and I'm going to sublease. All of a sudden then I'm going to become the lessor to that arrangement. So I'm the intermediate lessor, if you can imagine going along the chain. I'm an intermediate lessor to an ultimate lessee, okay? So what's the change? Well, under the new standard, the intermediate lessor, which is still, you're the lessee under the head lease, but the intermediate lessor has to assess the classification of that lease based on the right of use asset and not the underlying asset. So if you can imagine what that might mean, is if I'm assessing it up until now based on the underlying asset, if I sublease for 5 years, but I know I have a 10-year asset, and you're looking at your economic benefits associated with that asset, you might end up in operating lease world. Whereas as a lessor, if I'm looking at that as a 5-year lease with a sublease for 5 years, then chances are you're going to end up in a finance lease classification. So this change could change how you determine, how you classify your lease as that intermediate lessor to the arrangement with the sublease, okay? So there could be some changes in that regard, and that's a difference between where you would have been under IAS 17. IAS 17 would have said just look at the whole underlying asset, and so you ended up with a lot of operating assets, a lot of operating leases as a lessor. Clear, right? Lease modifications. IAS 17 up until now was relatively silent on how you account for lease modifications. If you went in and looked into US GAAP, there were gobs and gobs of information around how you deal with modifications, but IAS 17 was silent, and so there was a lot of diversity in practice and a lot of inconsistency around how companies dealt with modifications. If you're a lessor and you have a modification and you have an operating lease classification at the inception and you've modified that lease somehow, it's always going to be accounted for as a new lease. So that's the first thing you need to think about, okay? So there won't be any changes. It'll be just simply accounted for as a new lease. What happens, though, when I modify a finance lease? Well, if you modify a finance lease, the only way you're going to get to a new lease accounting is if that modification increases the scope of the lease and the amount that you're getting paid for that lease is commensurate with what you would have gotten paid on a standalone basis as if it was a new lease, let's say. So it's based on equivalent market rates for that increase in scope. So if that's the case, then basically you end up accounting for it as a new lease. Otherwise, you're left looking at it as a new classification. So, for example, if the lease changes from finance, let's say, to operating, then I need to count for that a modification either as a new lease or a new operating lease. Or if I go from finance classification and that classification doesn't change, then I would just simply account for that modification under IFRS 9, because all I've really done is just change a bunch of financial assets and liabilities. Okay? Disclosures for lessors. Again, same concept. How material is it? I always start with that premise, because if I've only got a handful of these things, Why do I have to have pages and pages of disclosure? If it's material to my business or fundamental to my business, then you're going to want to have all the detailed disclosures around the leasing arrangements that you have and how much exposure a company has under those leasing arrangements. Again, they encourage a lot of tabular disclosure for all the quants, I say, so put it in nice, neat little tables, keep it in one note. You're really going to focus on things like residual risk in those assets, information about the leasing assets themselves, and any changes that you've got, significant changes to your net investment in leases, so to speak. But conceptually, it's the same idea. An investor wants to know how exposed a company is or how embedded a company is with respect to their leasing arrangements, okay? So it needs to be fairly transparent. So that's it for leases. I know there's a lot of detail in there. We've just scratched some of the surface, and we've got a couple of more years to talk about lease accounting, no doubt. If you're sitting there today, you've got a couple of important decisions to make. Number one is you really want to scope how much work is involved within your organization. You got to put together maybe a working group to figure out who's going to work on leases and who's going to work on revenue. And figure out when you want to transition, because again, as I said, there could be certain synergies to transitioning 16 and 15 at the same time. I know it seems overwhelming, but from a processes and controls perspective, there may be some overlap and certain efficiencies, okay? So, with that, we're going to move on to some regulatory issues. I know there's a table here of regulators in the back, so I need to be careful with what I say. We're also going to talk a little bit about, there's a couple of regulatory matters we want to get to, and I want to close out the morning talking a little bit about auditor reporting, so I want to make sure I save a little time for that as well, because I think that'll be important. We're going to talk about whistleblower program. Everybody likes to know about the whistleblower program that was just put in place. We've got some key themes that have been emerging from comment letters. So we'll try and give you a bit of a list of things that we've been seeing. And again, we'll touch on auditor reporting in a little while. So what's happening with respect to the whistleblower program? Well, both Ontario and Quebec have both launched their independent whistleblower programs in the summer. And this is largely in response to what they've been seeing happening south of the border. So if you look at the SEC's program on whistleblower, I think it was late 2011, early 2012 that they launched their program. And they've declared tremendous success with the program. In other words, they've had more than 15,000 calls into the office of the whistleblower. They've paid out more than $85 million in awards to whistleblowers over the course of the last 4 years. And some of these awards have been quite significant. I think the largest one was $30 million. I think there was one for $17 million and $14 million. So seems like some pretty big numbers. Now, the OSC program award, they're going to pay amounts up to $5 million. So everything's a little smaller outside of America, right? They do things big. Canada, we're a little more small. So $5 million being the max, and of course that is likely the top end of the range. But the thing is that, these are financial incentives and awards given to someone to come forward voluntarily, so that it could be a bit of a game changer with respect to some of the enforcement cases that we might see over the next little while. So it should be interesting to see how it plays out. What would constitute a whistleblower? Well, basically it would be any kind of individual within an organization, or it could certainly be a group of individuals. Again, they need to voluntarily come forward, so it can't be because I've got a subpoena in my hands that I'm coming forward with this information. It needs to be voluntary. And it's to really report any suspected fraud violations or securities violations that could harm investors, right? So it could include employees, former employees, any suppliers or contractors that deal with that organization. Could be anything from a client, friends, family. So it has far-reaching effects. But it can't include people that are in roles of compliance. So for example, if you work within your organization and as part of your internal audit group, or let's say you're a member of the board or an officer of the company, any of those types of internal roles would not be eligible for an award under this program. The way it works is you've got to come forward voluntarily with original documentation or original information that the regulators don't always already have in their hands. And this would be based on independent knowledge that you've obtained from your exposure to that organization. And again, it's important that it's got to be voluntary. It can't be something subject to a subpoena or something along those lines. You know, you kind of read, I've read a lot of articles about this particular program, and it's not without a little bit of controversy, because I know a lot of companies and certainly their advisors are stepping back from it and going, well, isn't this going to encourage all these employees to circumvent a company's own internal compliance policies, to report things up through their organization, and just to go rogue and say, I'm just going to go straight to the commission with this because I think, you know, I want to get the award. So that's some of the noise you hear about the particular program. Companies are concerned that, you know, there's going to be all these investigations launched, and they're not going to have an ability to do any of their own internal investigation around the particular issue that's being raised. Whenever there's a regulatory action, there's also tag-along kind of civil actions that are launched, so they're concerned about that element of things. So there is a little bit of a controversy around the whistleblower program, so it should be interesting to see how it all plays out in the marketplace. In terms of what they're looking for, obviously any kind of illegal insider trading or kind of tipping. Fraud is another big area that they're looking for. Obviously, any kind of illegal distribution or unregistered trading of securities, all these types of things is what they're expecting to get reported up through this particular program. In terms of protections, they have put some protections in place. Confidentiality is obviously a big thing. And so some reasonable efforts have been taken by both of the commissions to make sure they have independent offices and that the submissions are confidential. Anti-reprisal measures have been put in place, so you can't actually go after a former employee as a company, litigate or go after them if they are in fact a whistleblower. So there's those types of protections that are baked into the rules. And again, this is one of these things where it's just been launched. They are open for business, as they say, but it'll be interesting to see how it plays out in Canada and see whether or not we have the same response as they had in the US. I don't see anybody running out of the room right now to go and whistleblow, so that's, I think, a good thing. So anyway, I'm going to talk a little bit about non-GAAP measures, because that's been the one area where we've seen a lot of activity over the last few months. Both the SEC and the CSA have each issued their own updates to their non-GAAP measure guidance. There was an interesting survey that I read about. I'm not sure what magazine it was, but there was a survey for Q3 of 2015, and it looked at all of the S&P companies, S&P 500 companies, and only 12% of those companies did not have one or more non-GAAP measures. So when you think about that, I'm no accountant, but that means 88% are using non-GAAP measures. So it's quite significant. And I think that's really what's caught the attention of the regulators over the last little while, is the prominence of these non-GAAP measures. Everybody's doing it. And the spread between the GAAP and the non-GAAP has actually gotten bigger and bigger and bigger. So much so that, you know, you could have a company that has tremendous amount of losses and is not really doing that well, and all of a sudden they'll have a non-GAAP measure that eliminates all the bad stuff and all of a sudden turns that company into what looks like a very profitable, well-performing company. So I think that's the big concern. How is that information useful to an investor? Are you not being misleading by promoting this non-GAAP measure that really is not reflective of your ongoing operations or some of the pain that you've had to suffer through some of these GAAP adjustments through impairments and write-downs and other things, or non-recurring items, restructurings, all that stuff. So how is that not a misleading measure? And how is it useful to an investor? And so those are the two key questions that we're often seeing companies get asked in comment letters. I will tell you, just from my own experience, and I think Sean's experience as well, is a lot of the letters that we're seeing for the first time are actually saying, well, you know what, your non-GAAP measures we don't think are appropriate, so therefore please revise your filing, i.e. revise your MD&A or your earnings release and refile that information. I just want you to think about that. If you have to refile your MD&A, that's equivalent to having to refile your financial statements. So I think it lands you on the wall of shame. I call it the wall of shame anyway. So think about that when you're putting your non-GAAP measures in your MD&A and talking about them and giving them more prominence than your GAAP numbers. Just a quick reminder, most of you probably have already seen the updated guidance that the CSA issued on non-GAAP measures, and this was largely done in response to IAS 1 amendments. The amendments basically said that you can't have subtotals in your income statement or your balance sheet as long as they're clearly identified and they're useful measures. So, for example, a company could technically have like an EBITDA or an EBIT subtotal as long as it was clearly labeled and it was useful and relevant to understanding the company's financial statements on the face of the income statement, in which case, arguably, that's not a non-GAAP measure, right? So the guidance was updated to reflect this fact. They also put in guidance around non-GAAP measures with respect to the cash flows. Be very careful when you prepare your statement of cash flows that you don't have any kind of unlabeled subtotals within that cash flow statement. And if you do, then you're also subject to the same guidance around having to reconcile and clearly identify it as a non-GAAP item elsewhere in your document. And also be careful about when you change composition of your non-GAAP measure. I always say if you're going to change how you calculate something, particularly this particular measure, you've got to tell people that you've made the change, tell them why you've made that change, and you're also going to want to restate all the comparative periods and make it clear that you've done that when you present that non-GAAP measure. What are some of the comments we're seeing? Well, I've already shared a little bit about, it's about whether the measure is misleading or are you, how is it useful and not being clear around that. But the other big issue is prominence. And so companies will, you pick up a press release and you'll see, the first 3 or 4 bullets within a press release are all about the non-GAAP performance measures. And they're bolded and highlighted. So I always tell people the order and the font matter. So if you're going to put the non-GAAP measure as a lead story, make sure you have equal prominence also given to the GAAP measure. Okay? So be careful about things like that. And the SEC have raised that as well. The font and the order and how you present it really matters. Companies are also writing entire MD&A based on a non-GAAP measure. So in other words, they simply mention what the operating income is, or a loss usually, and then they go on and speak significantly about the non-GAAP profitability of the company, which really isn't reflective of historical performance. So there is a balancing issue here you need to think about. The label also matters. So if you're going to call something EBITDA, just make sure it's actually just EBITDA and don't adjust for other things. Now, yes, you can call it adjusted EBITDA, but that's when you get on the slippery slope of what are we trying to achieve? Is this a performance measure? Is it a liquidity measure? Am I eliminating out costs that are meaningful to my operations and my performance? Okay, so the label of it matters. If you're going to consider something, if you're going to imply that your non-GAAP measure is an operating measure, make sure you're not eliminating operating cash costs. That's going to be important. Okay? So what is the SEC having to say about non-GAAP measures? Well, they have a lot of the same key themes that we've already mentioned. They have also independently updated their guidance. So if you are an SEC reporter, you're going to want to take a look at the CD&Is. They've been updated. And that really it really focuses on areas around whether or not a non-GAAP measure is misleading. And so they've been very explicit in saying if you're taking a measure and you're adjusting to eliminate out operating cash costs, then that could be a problem. Because if you're looking at something as a performance measure and you're taking out, it's one thing to eliminate a non-cash cost and you're kind of getting into a liquidity measure, but if you're eliminating out cash operating costs, then the staff are going to object to that approach. They're also focused on prominence, so the same kinds of issues on, omitting the comparable GAAP measure, having your lead story as the non-GAAP item. They're also focused on cash flow per share type measures. So if you take a non-GAAP measure and you do a per share calculation on that, be very careful, because if it's more akin to a liquidity measure, the staff will object and prohibit that measure. Okay? So I know a lot of companies that take a numbers and they look at it and say, well, that's really a performance measure. If the staff interprets that to be more of a liquidity measure because you're adjusting for all the non-cash items, then you shouldn't be doing a per share calculation on that measure. And I know a lot of companies do that. Okay, let's change tunes a little bit. I want to talk a little bit about CSA comments on their continuous disclosure review, and a lot of this is presented in their reports that they've issued by both the CSA and the OSC, as well as other commissions in Canada have also issued independent reports on their continuous disclosure reviews. They're a good read for companies going into their year-end reporting, just as reminders of certain things that companies haven't done particularly well. You might want to take a look at some of the key observations, and they provide a good summary. The way they write their reports now, they provide a decent summary of what they identified and then suggestions on how it can be improved or what best practices are. Interestingly enough, 62% of those reviewed required some form of action, whether it was changing things on a prospective basis or having to refile or an enforcement action. But 62% compared to last year, I think it was around 59%. So we're in the same ballpark, although we're going up, so the trend isn't good. We want to see it coming down. In terms of specific things that they've raised, I'll just go through a few quickly with you, just as quick reminders. Operating segments, always a favorite for the regulators, also a favorite certainly in our office. I know Sean and I spend a fair amount of time talking to companies about how did you actually figure out what your operating segments are, and how did you aggregate all these operating segments into one, is usually where I start. I always tell people, if you've aggregated so much that an investor would have made a different decision had they seen the operating segments on a disaggregated basis, then I think you've probably aggregated too much. And that's a good thing to think about when you're kind of laying out your segments. If you're obscuring really poor performing segments, chances are the economics are such that they shouldn't be combined. Okay, so think about that when you're doing it. And that's really the main issue they've raised, is there's just too much aggregation. And when you do aggregate your segments, there's significant judgment there, and companies aren't disclosing that as a significant judgment. Okay. Market rate sensitivity. The issue being raised here is companies just aren't reflecting the appropriate disclosures that are required under IFRS 7. Remember, your market risks are your currency risk, your exposure to interest rate risk, and any other price risk. And companies just, you got to disclose what your reasonably possible change might be. And companies are just picking these arbitrary 1% or 5% numbers, but you really got to focus on, is that a reasonably possible change, and what that impact will be at the financial statement period. Okay, so some companies aren't putting the disclosure in at all, and others are just picking a meaningless percentage. So you really need to think about how you determine what's reasonably possible, and is it relevant. Credit risk on accounts receivable, you'd think with the year we've had with so much impairment and kind of economic downturn, that companies would have had more disclosure with respect to credit risk associated with their receivables, when in fact that didn't happen. And I think the staff are looking at these reporting documents and saying, well, why isn't this all of a sudden a heightened credit risk? Companies are just overlooking it all entirely and failing to provide all of the disclosures that are required for your credit risk, such as analysis of the age of accounts that are past due but not impaired, information about the credit quality of your specific financial assets, things of that nature. So pay attention to that. If you have economic issues associated with your receivables, you're going to want to make sure you've got the right disclosures in place. Business combinations has come up again, usually does most years. Couple of observations that the staff have made with respect to business combinations. One is they're zeroing in on intangible assets, and so this is the age-old issue of doing a business combination and lumping the entire excess to an intangible asset or goodwill, and not really splitting it out appropriately into its different classes of assets. So companies are doing a poor job of identifying what those intangible assets are. And they're also doing a poor job of identifying what the estimated useful life is. A lot of them also assume that it has a useful life that's indefinite, so it's lumping it again and lumping it into a goodwill. So there was a lot of comments around intangible assets in that regard. Contingent consideration is also on the list. This is one of those areas where you make your best estimate at the date of acquisition with the information that you have, and so you fair value what your contingent consideration is. And then things happen. Two things can happen. One is you start to identify more information that existed at the time, and so you want to make a measurement period adjustment to that contingent consideration, and that's fine, but make sure it anchors back to facts and conditions that existed at that date. And then the other issue that they've noticed is that companies are resolving the contingent consideration, and you need to make sure that that information is accounted for prospectively. That has nothing to do with the measurement period adjustment, okay? So it's not part of your purchase accounting. It's only part of the subsequent measurement of that contingent liability, okay? So once it's resolved and the outcome is known, then that goes through your P&L. It doesn't sit in your purchase accounting. There's a slide here on impairment. I don't want to spend too much time on it because we're probably sick to death about impairment because we've had a lot of them this past year. The one thing I did notice as I went through a lot of the disclosures for clients this year is companies are really good at saying, well, my key assumptions that I've used and that I'm most sensitive to, that I have to disclose, are my growth rate or my pre-tax discount rate. So people are happy to throw those in, but they forget that the most significant key assumption is the cash flows that you're using and how you determine those cash flows and what the rates are within that period. So don't forget, if you do have impairment, that's one of your most important key assumptions, is how I determined the cash flows over that 5-year term, for example, in my present value calculation. Okay? I also want to remind people about reversals of impairment. What gets written down might have to go back up. And we're not used to doing that under IFRS because, well, Canadian GAAP never permitted it. And then, quite frankly, we're now in a point where maybe things are starting to turn up, right? So you need to look at your indicators for reversals of impairment and also calculate those and factor those into your analysis at year end if, in fact, you've had them. Bear in mind, however, and I've had this question many times, if people had an impairment, let's say, and the market, one of the indicators of an impairment was the market cap had fallen, bear in mind that just because the market cap has gone back up, that is not an indicator of a reversal of impairment. It's not on the list. So go back and take a look at your indicators of your external factors for reversals. You will not find the market cap indicator. Okay? Now, if your market cap's gone back up, that means other good things have happened that you've reported with your company. So you can probably fit it into some of the other indicators for a reversal. But don't automatically assume just because the market has responded positively that you have a reversal. Right, Sean? Okay. couple more things, just highlight a couple of things on MD&A, everybody's favorite topic. I know I love reading MD&A every day. Highlight a couple of things from OSC observations on MD&A. I've listed on your slide. A lot of the things will be familiar to you. Obviously, results of operations is one of them that people don't do a great job at. I always say results of operations isn't that good because people are too focused on the non-GAAP measure and they're not giving a balanced approach. We've already talked about that. But also make sure that you have good quantitative analysis in your results of operations. I want to talk about segments. Your reportable segments have a segment measure, right? Management says this is my segment measure for those reportable segments. Make sure your MD&A actually speaks to that segment measure, because if management says that that's the measure I'm evaluating my segments on, why would your MD&A then speak to a different measure? And we do see that from time to time, and the OSC has noted that. They've also noted that companies just aren't providing analysis by segment in their MD&A. And remember, it's supposed to complement, the MD&A is supposed to complement what's already in your financial statements. Liquidity and capital resources. This is one of the areas of the standard that, the section of your MD&A that suffers from boilerplate. Most of the time, companies will just take their cash flow statement and reduce it into words very creatively, but it's not actually really saying anything, so you really need to focus on having some substance between what your short-term and your long-term capital requirements are and how I'm going to fund those. A couple other slides I just want to highlight. Liquidity and capital resources, just spoke about. When you look at the CSA report, they actually highlight a couple of areas as well with respect to MD&A that they've noted. Again, I mentioned boilerplate, not reducing your cash flow statement into words, but you also need to be careful. I always tell people, let's not have any big surprises. So, and lawyers will fight you on this. They'll say, well, we're not putting that in there that we think we're going to have a breach or a covenant violation. Well, but if you think you're going to have a problem in the coming months with respect to liquidity, or you think your borrowing capacity is going to be lowered, and it'll have a pinch on, how you spend your money and whether or not you can meet your budgets and your operating capacity, then you're supposed to be talking about that in your liquidity and capital disclosures because the risk exists. So I always kind of say, well, I don't want to see big surprises in Q2 or 3 when I could have spoken a little bit about it in Q1. Anyway, that's an argument you're going to have with some lawyers, though, because they own the MD&A. So, operating segments. We talked about most of the high points on that one. Remember, make it consistent and make sure you talk about your operating segments in your MD&A. Don't overlook them and use the same performance measures for each segment. Venture issuers that don't have significant revenue. Oftentimes I'll pick up MD&A or continuous disclosure documents for venture issuers, and let's say it's a mining company and that has all these particular projects or prospects and properties. The first major part of that MD&A will be a repetition of things that are already maybe in their AIF. So it talks about the properties since 2001, and they're still they're still drilling or putting holes in the property, trying to figure out if they've got successful reserves. So they give an entire history, and then there's one little paragraph that speaks to what they did this last year. And sometimes the paragraph just says, well, we really didn't do anything, but we still own the property. Make sure that you don't have all that ugly history in your MD&A. Make it meaningful, update what's happened during the year, what you spent, what you think you might spend. Focus on what's new, because a lot of that information is already elsewhere in the continuous disclosure documents. Forward-looking information, that's just another area where companies just don't seem to want to update. I always say forward-looking information is where you tell the world what you think is going to happen, right? And then in the subsequent period, you fail to update what actually didn't happen. So you need to update your forward-looking information and say, well, we actually didn't achieve those results, but we've revised our budgets and our operating estimates, or we overachieved, right? But you need to update that forward-looking information. It has to be maintained currently, okay? If you've missed targets or your objectives have changed, then it's important that you just reflect that in your forward-looking information. Just a quick reminder about audit committee composition for venture issuers. You need to have a minimum, as of Jan 1, 2016, you have to have a minimum of 3 members from the board of directors. And those members, the majority of your members cannot be executive officers, employees, or people in roles of control of that organization. Or it can't be an affiliate of the venture issuer. So these are some new rules. Talk to your attorneys if you don't think you've changed the composition of your audit committee to reflect these new rules. Okay, so auditor reporting, final topic of the morning. I just want to touch briefly on what's happened. I know we talked about this last year. You're probably thinking, well, why am I really worried about what my audit report says? Remember, the audit report hasn't changed in years and years. It's a pass-fail type audit report. At the moment, the International Auditing Board has issued 2 new standards dealing with auditor reporting. One deals with the inclusion within an audit report of critical audit matters or key audit matters. And these are really matters that, in the auditor's judgment, were the most significant to the audit, right? And so what it requires is that the auditor include those key audit matters within the auditor's report. There's also a standard on other information and the type of work that the auditor has done and whether or not they've done that work on other information that accompanies the financial statements, i.e., like, let's say, the MD&A. Okay? Now, those standards have been issued. They're effective for calendar year end 16. Now, the Canadian board comes along, and they usually adopt the international auditing standards with very minimal or none at all amendments, right? So they'll usually adopt them concurrently. But in this particular instance, they've actually deferred the adoption by a year. And they did that because they didn't know what the PCAOB was doing. And when you think about the contingent of reporting issuers in Canada, there are many, many Canadian public companies that also report under PCAOB reporting standards. So you can imagine having to issue one audit report in Canada under CAS's, and then also reporting under PCAOB reporting standards. So it's this dual model, and that has caused them to put a pin or kind of a pause button on saying, well, we want to wait and see what the PCAOB is doing. Well, during this past year, the PCAOB has actually issued reproposals. They have signaled that they are intending to go ahead with something that's comparable to the ICE's, although not identical, but in substance, they're going in the same direction. And so I think you could see something coming from the Canadian Auditing Standards Board before the end of the year in terms of moving ahead and adopting ICE's. Which could mean, I'm not sure on the effective dates at this point, but it could mean that we could have a significantly different auditor's report in the next few years. So this is one of those ones where I say stay tuned. It's interesting, the PCAOB have decided they're going to move ahead, but we also know we have an election in the U.S. Unless you live under a rock, you don't know. We have an election in the U.S. in November, and elections change things from the political standpoint. So anything can happen with the PCAOB, so I think this is one of those ones where you have to really wait and see if they plan on going ahead as well. Okay, so I think, how's our time, Sean? I think I did well. I think we're 10 minutes ahead of schedule. Brings us to the end of the morning. I do want to thank you for coming. I know there are a lot of different ways you can get technical updates these days. You can kind of sit in front of your computer and do a webinar. I always think it's good to get in front of people and sit face-to-face in a room and network and talk. Couple of reminders before you leave. We do want your feedback. It is important. We want to get better at this every year, so if you do have any specific feedback, happy to hear it. You can fill out a card. Is there a card this year? Is it all kind of online? I have no idea. I think there's card and I think there's lunch. That's all that matters. Okay, perfect. You know about the app, so you can certainly download that after if you haven't done so already. And also, Sean and I will both be around for lunch, so if you do have questions on any of the topics we've mentioned this morning, happy to chat about them or anything else that you'd like to chat about. And again, thank you for coming, and enjoy the rest of your day.